Welcome to TheoTRADE. This is Don Kaufman. It's October 11th, 2023. Just about 8 minutes to go to the cash close here on this Wednesday afternoon. S&Ps once again taken off to the upside. But I got to tell you, it's not the S&Ps that are on my mind. It's all about the bonds. Look, the bonds, they've recovered, but risk still looms large in the overall marketplace. Let me explain precisely what I mean. Let's get right to it here on this evening's video. So we'll start in the S&Ps. Obviously, guys are looking at them. Hey, they're up some 17 handles. People are high-fiving one another. It's not what I would have expected. And I'm going to start with that. It's not what I would have expected. Why? I would have expected much, much more. So we've had a bit, if you will, of a rip your face off rally the last like 4 trading sessions. That is possibly brought to you by a big reactionary low inside of the bond market. But I got to tell you, I would have thought that the Nasdaq would have gone even further on this, and it hasn't. Some of the sectors, they just have not necessarily moved enough. And obviously, we're dealing with considerable geopolitical risk, but I'm actually going to read into not what we think, okay, but what we can actually read into specific to volatility, specific to the bond product. And again, we're going to look at a number of indications over here that are still pointing to fairly considerable risk in the marketplace. So let's get right to work. I mean, look, to state the obvious, where's the market right now? Let's cruise over to the SPX. And the SPX will do this some justice here. So what you're looking at, that line right up here, and I'm going to highlight it, that line happens to be none other than it's the upper edge of the expected move for the week. All right, that's the SPX upper edge of the expected move. Let me actually cruise out to the daily chart, kind of zoom into this to some degree, and I'll show you exactly what this kind of entails. So this week, trade was expecting approximately a $76 move. Now that's $76 move, higher or lower. That's the expected move for the week. We already tagged it as of Tuesday. We literally hit the expected move, reverted back down off of it. We're right back up there. So look, I wouldn't be surprised in the next couple of moments to actually see us drive right into the expected move. And for those of you, if you're kind of curious, the expected move, it's all about the SPX, and the expected move in the SPX, the upper edge of it is 43.85. As I said, literally the high yesterday, 43.85 on the button, people. But, you know, with the overnight trade, CPI coming out tomorrow, yeah, we could drive right into the upper edge. But as I said, there's still like a degree of risk. And you look at stuff like VIX and you're like, oh, well, yeah, but the VIX backed off a little bit over here. Okay, one of the things that I look at in terms of risk, right, has a lot to do with the volatility futures and what we term contango and backwardation. And there's one very notable aspect over here. If we're looking out to the November versus December volatility futures, and again, I'm going to write it up here because it's a little hard to see if you're looking at this on a smaller screen, but the November volatility futures are sitting at 1735, and the December volatility futures are sitting at 1775. The distance between them right now, look, this is not, higher math over here. It's about 40 cents. That's incredibly tight. Okay, it's incredibly tight because we've rallied a decent amount. I mean, look, I'm not going to sugarcoat the S&Ps have ripped, right? So the S&Ps, it's a rip your face off rally. But the point that I'm trying to make and why I say that the bonds recovered and everybody's like sounding the all clear, okay, don't get ahead of yourself. The risk still looms large as long as those volatility futures are that tight, because the volatility futures, the risk to just come raging back. Volatility futures are just a hop, skip, and a jump away from completely inverted. That'll change the way you feel about this marketplace in a hurry, people. Moreover, if you take a look at the SPX, it already did what it's supposed to this week, right? So it tagged the upper edge of the expected move. Does it mean it can't go higher? Absolutely not. What I'm looking now at the SPX, again, boom, we hit the upper edge. Now what am I really looking at? I'm looking at, the CPI for tomorrow. and I'm not looking at the CPI number. Honestly, I could care less. You know, the CPI is going to come out. PPI came out today. PPI was it was hot. It was hot to the touch. What I'm basically meaning by that is PPI maybe displaying a little bit of inflation still. But CPI tomorrow still has quite a bit of volatility packed into it. You are sitting right now on almost between a $36 and $37 move for tomorrow, based on again that CPI number coming out, which is very much an elevated move. Okay, in overall markets. Now that's not to proclaim that it's going to be up or down. Okay, the key point in here is going to be the bonds. Right? Is tomorrow's CPI going to continue this rally, okay, or the bond's going to fade? I have to be very forthright in making this argument. I was talking about it extensively on the weekend update, and I'll reiterate again. I can definitely see these bonds starting to rally, especially in the midst of geopolitical risk, okay? We have just, I mean, there's a lot that looms large out there. I mean, obviously, people have to be shocked. You're looking at oil like, I can't believe it's down to $84 a barrel. You're looking at the VIX and you're like, it's not really reacting to some of the geopolitical risk. Maybe not, but the bonds very well maybe. Those bonds, okay, I mean, this rally can absolutely correspond to some of the geopolitical risks. So you're seeing movement towards the bond product right now. And again, I could see a circumstance where the bonds continue to rally and they start hitting the S&Ps and buying bonds. Okay. I can also see a circumstance where the bonds could turn around and sell back off. Let's say that the CPI, okay, consumer inflation comes in hot, effectively meaning that inflation's still not dead. If that CPI number comes in just a little bit hot, bonds could sell back right back off. That could hit the market as well. Like, it's just, there's just no way to put this nicely. This just, look, I'm not going to sound the all clear in the S&Ps at this point. Okay, take it for what it's worth. The S&P rally, this is the quintessential, you know, it's the dead cat bounce. We no animals were hurt in the making of TheoTRADE. It's the quintessential rip your face off rally. And until we actually see some follow through to it, look, risk is still going to loom large in this marketplace. Now, I'm not even going to break down sectors all that much because, you know, the financials, which were a big portion, the financials were rallying before the rest of the marketplace was rallying. Financials were a big portion of this rally. They're not even involved really this week. They're not even but halfway home to the upper edge of the expected move. If you look at the energy sector, it jumped, but it's geopolitical risk. Okay, it's once again, people, it is all about the Nasdaq. And that's exactly why I'm starting to pay such close attention, because the Nasdaq, I mean, on a day-to-day basis, there's now rotations within the Nasdaq itself. We're buying NVIDIA. There's the closing bell. Buying NVIDIA, selling a little bit of Tesla. Okay, Microsoft is bid. It's like stuck in the middle with you. Every day we're seeing rotations, again, as I said, within the sector itself. It's not healthy inside of that trade. But on a day-to-day basis, when you come in the morning, like CPI is going to be rocking tomorrow. There's no question. Futures are going to do a lot of, you know, contract size. The bonds are going to be all over the place tomorrow morning. The volatility in the bond market is also heavily elevated. Take a look at like TLT. Just go 2 days out, like a $1.35 move. Yeah, put on your big boy pants. That's a significant move. The implied volatility is higher inside of the TLT, considerably higher in the TLT than it is in the S&Ps for the next few days. Anyway, with that being said, it's going to be tech and tech order flow after the bell that's going to dictate S&Ps, okay, to a larger extent. This is not going to be easy trade. As I said to you, gotta watch, all right, those vol futures. I am not going to be sounding any all clear to this marketplace unless those volatility futures widen out, okay? To what extent? Everybody likes really specific levels, okay? Until you see like November, okay, diverge, all right, from, for instance, December by the amount of about 70 cents, I wouldn't sound the all clear on this one. All right, so that's pretty much it for, again, this evening's video. Again, hands and feet inside of the vehicle during tomorrow's CPI number. Once again, you can see that the SPX closed here at 43.76, just 10 handles shy. But here's the irony. Right into the close, look at this. We're reaching, people, reaching for the upper edge of that expected move. It is the warm and fuzzy place in this marketplace. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.